Welcome to Unit 5. In this unit we're going to look at the accounting for merchandising operations. Merchandising always seems like an old term to me. We talk about retailers today. I don't hear the word merchandising get used a lot, but accounting textbooks tend to like it. So merchandising operations are a little different from other types of operations. Their operating cycle is a little longer than service industries, not as long as manufacturing industries. And we're going to look at the flow of cost. We're going to learn a couple new phrases, or at least new concepts: perpetual and periodic inventory system. Perpetual is where we keep track of the inventory all the time, and periodic is where we go out periodically, i.e. every now and then, it's not that random, and take account of what we have on hand. We're going to look at how we record purchases of merchandise for resale, how we handle freight cost, what we do when we purchase something and want to return it, what happens when there's a purchase discount involved, and then we'll do a summary of purchasing transactions. Then we'll look at the sales side, the revenue side, how we handle things when customers bring goods back to us, and what kind of sales discounts we might be involved in granting. Then we'll look at completing the accounting cycle, the adjusting journal entries that are necessary with merchandising businesses, how to make closing entries, and then do a summary there. And finally, we'll look at some variations of the financial statements. Retailing merchandising operations have a new section of the income statement called the cost of goods sold section. And we'll look at some single-step, multi-step income and move on to balance sheet. So merchandising companies, I call them retailers. They buy and sell goods. The examples they got here are pretty common to most of us: Kmart, Home Depot, Walmart, the ever popular Target, and so on. Their primary source of revenue is referred to as sales revenue or sales. Income measurement. We take sales revenue, the box in the green on the left, less cost of goods sold, gives us gross profit. There's a little bullet point kind of in the middle. Cost of goods sold and gross profit aren't relevant to service businesses because they're selling services, not merchandise. And from gross profit, we subtract the operating expenses, and that comes up with net income. So the operating cycle of a merchandising company is ordinarily longer than that of a service company. It's because it takes us a while to buy the goods, put them in inventory, and sell them. Some folks are faster at it than others. A perpetual inventory system. When you buy something, when we purchase something, we increase our merchandise inventory account. Merchandise inventory account is an asset account. It's a current asset account. Freight costs, purchase returns and allowances, purchase discounts are included in merchandise inventory. And when we sell something, cost of goods sold is increased and merchandise inventory is decreased for each sale. So at the time we have a sale, we're going to record some revenue, but we're also going to record the cost of the goods sold. A physical count is done to verify that we get everything right. The box at the bottom says perpetual inventory system provides a continuous record of merchandise inventory and cost of goods sold. That's true. A periodic inventory system, when we purchase merchandise, we put it in a special account called purchases. We don't debit inventory directly. We're going to debit purchases. Our ending inventory is determined by our physical count. We don't keep a running tally of the inventory, and we have to do a calculation to figure out cost of goods sold. Look at the beginning inventory, in this case 100,000, plus whatever we purchased, 800,000. That means we've got 900,000 available for sale. And when we went out and counted, we counted $125,000 worth of goods. So that means we must have sold 775,000. Some people argue at this point it must mean you sold that much, or you sold and people stole that much. But we at least had that much go out the door whether we sold it or it got heisted. So recording purchases of merchandise made using cash or credit on account. They're normally recorded when the goods are received. Purchase invoice should support each credit purchase. So we should be getting an invoice from the supplier. That will be our documentation and trigger our making the entry. We probably have a shipping receiving department somewhere that when we get something, they make a note that we got it. Under the perpetual inventory system, companies record a merchandise inventory in the merchandise inventory account to purchase goods they intend to sell. Illustration from invoice number 731. Record the journal entry Sock Stereo would make to record its purchase from PW Auto Supplies. They would debit merchandise inventory of $3,800. They would credit accounts payable of $3,800. Freight cost. We need to look at who's paying the cost of the shipping, the cost of the freight. There's two common designations here, FOB shipping point, and FOB stands for free on board. So if it's FOB shipping point, once it leaves the shipping point, then the buyer pays for the cost of the transportation. If it's free on board FOB to the destination, then the seller pays the freight cost. So FOB shipping point or FOB destination. You might take a little bit of drill to get those in place, but once you have them, lucky for us, they won't change. So illustration, assume upon delivery of goods on May 6, Sock Stereo pays Acme Freight $150 for freight charges. The entry on Sock Stereo books is merchandise inventory $150 and cash $150. And bottom assumption here, assume the freight terms on the invoice in illustration 5.5 had required PW Auto Supply to pay the freight charges. The entry by PW Auto Supply would have been freight out or delivery expense and cash. In which case, Sock Stereo wouldn't have had to make any entry. Purchase returns and allowances. Things get returned. The buyer may be dissatisfied. The goods are damaged or defective, or they're not good enough goods, or they don't meet specification, or there's a whole variety of reasons that people send things back. So if it's a purchase return, then the goods are returned for credit. If the sale was made on credit, we'll receive a credit. Otherwise, typically we'll ask for a cash refund. And sometimes we may get a purchase allowance. A supplier might have sent us something that wasn't quite what we asked for. We call them up and say we want to send it back. They say, "Oh boy, we're really sorry. If we discount this by 10 or 20% or whatever number, would you agree to take it?" And we might look at it and say, "Sure, we can. If you want to discount it 20%, we can move the item and make some profit on it." So in that case, that would be considered a purchase allowance. A question: in a perpetual inventory system, a return of defective merchandise by a purchaser is recorded by crediting merchandise inventory. We're going to debit accounts payable or debit cash and credit merchandise inventory. Another illustration here. Assume that on May 8th, Sock Stereo returned to PW Auto Supply goods costing audio. I'll get it right. Supply goods costing $300. The journal entry we'd make, be to debit accounts payable $300 and credit merchandise inventory $300. Purchase discount. Purchase discount it's an incentive that the seller grants to the buyer to encourage the buyer to pay promptly. Most businesses buy things on credit, and some people can take advantage of that, of the credit terms, not pay very timely. So businesses might offer an incentive to those people who pay within a certain time period. In the box at the bottom here, it says credit terms of 210 and 30 is read 210 net 30. So we get a 2% cash discount if the payment's made within 10 days. If we don't make the payment within 10 days, we don't get the discount. And as we'll find out, probably at 2% in 10 days is a very excellent rate of return. So different terminology you might run into. We've done the 210 net 30 days. Might be 1% discount if paid within the first 10 days of the end of the next month. First 10 days of next month. Or a net 10 end of month. Net amount due within the first 10 days of the next month. Another illustration here. Assume sock storage pays the balance due at $3,500. That was the gross of $38 less our return of $300 on May 14th, the last day of the discount period. Prepare a journal entry sock makes to record its payment. Well, we're going to make a payment, so we know we better be crediting cash. And we're going to debit accounts payable to eliminate that $3,500, and then we get to compute the merchandise discount, and that's $3,500 at 2%, which equals $70, and that becomes a credit, a reduction to merchandise inventory of $70. So we owed them $3,500, we get to claim a $70 discount, we actually pay them $34.30. The sock stereo fails to take the discount and instead made full payment of $3,500. The journal entry would be debit accounts payable $3,500 and credit cash $3,500. So here's kind of the $1,000,000 question. Million's a little exaggeration, but should discounts be taken when offered? So a discount of 2% on $3,500 is $70. If you took the $3,500 and invested it at 10% for 20 days, you'd only earn $19.18. So you earn way more than 10% by taking the discount. Their calculation down here, 2% for 20 days equals an annual rate of 36.5%. So that is a very good rate of return, and if businesses can afford to take the discount, if they've got the cash, it just makes sense for them to do it. In fact, it makes sense for them to borrow money so they can take advantage of discounts. So here's a summary of the T account. You can see that on the 4th of the month, the purchase was a debit of $3,800. On the 6th of the month, we had the freight in of $150. Then we had credits. On the 8th, we returned some merchandise for $300. And on the 14th, we took a $70 purchase discount. So that leaves us with the balance of $35.80. When we record the sale, be it for cash or credit, we make these kinds of entries, but normally this entry is recorded when it's earned, usually when the goods are transferred from the seller to the buyer. Usually that's when title transfers. And the sales invoice gets created, and that becomes the documentation for each of the entries. So if we're using a perpetual inventory system, we've got 2 journal entries to record a sale. The first actually records the sale, a debit to cash or accounts receivable if they didn't pay us cash, and we're going to pay us later, and the credit to sales. And then we make an entry for the cost of the merchandise. That will be a debit cost of goods sold and a credit to merchandise inventory. Now, we just use X's in here. They didn't give us any numbers. And I'm going to tell you these two numbers, the sales number and the cost of goods sold numbers, are different. Which of them is going to be the larger of the two? And the answer is the sales number is going to be the larger of the two. If it isn't, then we're selling something for less than what we paid for. And if that happens, we're probably not going to be in business very long. So here's another example. Assume P&W Auto Supply Record records its May 4th sale of 3800 stock stereo as follows. And assume that the merchandise cost PW Auto Supply $2,400. So we're flipping the side of what we've been looking at here. So it's a debit to accounts receivable of $3,800, credit to sales of $3,800, debit to cost of goods sold for $2,400, and a credit to merchandise inventory for $2,400. Now, when we had the sales return there, that the purchase return, to us it now becomes a sales return, and that becomes a contra revenue account, and the sales isn't reduced because it would obscure the importance of some percentage of sales numbers. It could distort comparisons between sales in different accounting periods. Next, I've never particularly bought any of those arguments, but that is the way we do things in accounting, so we'll do it in this course as well. So prepare the entry that P&W Auto Supply would make to record a credit for return goods that had a $300 selling price, assuming a $140 cost. Assume the goods were not defective. So if they're not defective, then we're going to put them back into inventory. If they were defective, then we wouldn't put them back into inventory. So we debit sales returns and allowances, credit accounts receivable. That reduces how much the buyer owes us. And we debit merchandise inventory for $140 and credit cost of goods sold for $140. That puts it back in inventory and takes it out of cost of goods sold. So here's the assumption. Assume the return goods were defective and had a scrap value of $50. P&W Auto will make the following. We debit the sales return allowance, credit accounts receivable. That's the same. Before the next entry, they debit merchandise inventory for $50, credit cost of goods sold for $50. So review question. The cost of goods sold is determined and recorded each time a sale occurs in A, a periodic inventory system only, B, a perpetual inventory system only. That's your like B. Here's kind of a rhetorical question about sales returns and allowances. And here's the example in the publishing industry, be it hardcover books or textbooks or whatever, that it's a tough business. And bookstores don't want to buy books if they don't have the ability to return them. If the bookstore can't sell a book, they don't want to get stuck with it. So most publishers have permitted bookstores to return items. And books are pretty expensive to ship, so the cost of freight gets to be expensive both coming and going. And their question here is, now that returns of hardcover books exceed 34% of sales, how much longer can publishers keep doing this? And what happens if they stop? Sales discounts. They're offered to customers to promote prompt payment. They're the flip side of a purchase discount. They're a contra revenue account, a debit item. Illustration. Assume stock stereo pays the balance due of $3,500. Gross invoice price of $3,800 less than $300 allowance that we gave them. On May 14th, the last day of discount period, prepare a journal entry PW Auto Supply makes record receipt on May 14th. Well, we know they're going to debit cash for some amount. We know they're going to credit accounts receivable for some amount. Accounts receivable $3,500. We figured out that sales discount at 2% of $3,500. So that cash is going to be the balance there, $3,430. Adjusting entries. it's the same concept as the service company. We do make an additional adjustment to record. Once we go out and physically count the inventory, we need to adjust the merchandise inventory count. But other than that, we make the rest of the entries the same. This confuses students sometimes that with both a perpetual where we're keeping track of inventory all the time and a periodic inventory system, we still need to go out and do a physical count at the end of the counting period. Even though perpetual is keeping track of it, goods can get lost and damaged and merchandise or destroyed, and things can happen in the warehouse or the store. So we really never have a good count unless we go out and make the count and adjust physical inventory on the books to what we actually counted. So it says, suppose that PW Auto Supply has an unadjusted balance of $40,500 in merchandise inventory. Through a physical count, they determine that actual merchandise inventory at year end is $40,000. So, we always want to know what happened to the 500. It could have been a math error at some point. An employee could have stole something. An employee could have dropped something and damaged it. A custodian could have thrown something away by mistake. There's all kinds of things that can happen to that inventory. But for our purposes, for accounting purposes, we need to make an adjusting entry to correct the merchandise inventory. And we do it by debiting cost of goods sold 500, crediting merchandise inventory for 500. These are typical closing entries. You'll remember that sales normally has a credit balance. To close it, we debit it, credit income summary. Then we have all of our various accounts that normally have debit balances. We close those by crediting them. Sales return, sales discount, cost of goods sold, blah, blah, blah. And we close out the income summary account, and we close out the drawing account into capital. We're going to look quickly at a multi-step income statement. It shows several steps in determining that income. 2 steps related to principal activities, and it distinguishes between operating and non-operating activities. And that's a pretty important distinction. We want to know how well the business is doing operating, and we want to know about the other non-operating things, but those tend to be more happenstance and unusual and not as frequent. We really want to understand how the fundamentals of the business are working. So calculation of gross profit, we take our sales information, we come up with net sales, we compute cost of goods sold, and the difference there is a gross profit. And we configure gross profit rate, which is the gross profit divided by the net sales. That gross profit rate is real helpful in comparing one company to another. You would expect companies in similar industries to have pretty similar gross profit numbers. If there's not, then there's a question as to who's doing something smarter than the other person. So here's back to this multi-step income statement. We have the sales revenue, cost of goods sold, gross profit, and then we deduct the operating expenses. From operating expenses, we deduct those from gross profit, come up with income from operations. Then if we have some non-operating items, we'll show those. And their example here is that we had some interest revenue of $3,000. We had gain on the sale of equipment of $600. And other expenses and losses, we had interest expense, and we had a casualty loss from some vandalism of $200. So those net out, our non-operating activities net out to $1,600, and that increased income brought net income up to $31,600. The single step income just takes total expenses and subtracts them from total revenues. It's easy to do, easy to read. It's just not very customary. Here's an example of a single step that they show all the revenue items, including the interest and the gain on sale of equipment, which are non-operating, and they deduct the expense items, cost of goods sold, operating, and so on, come up with total expenses, and difference is net income. On a classified balance sheet, we now have this new account, merchandise inventory. You can see that it shows up normally after accounts receivable. It's typically less liquid. It'll take longer to convert to cash than accounts receivable. And we'll take we've been looking at perpetual. We'll take a brief look here at periodic systems. We use separate accounts to record purchases, freight costs, returns, and discounts. The company does not maintain a running account that changes inventory, and ending inventory is determined by physical count. Now that last one, you'll remember, is also true of perpetual. We think we know what we have on hand, but we still have to go out and do a count to confirm it and adjust it for anything missing. So our calculation cost of goods sold is we take our inventory at the beginning of the year, add our purchases, subtract purchase returns and allowances and purchase discounts, come up with the net purchases, add any freight that we paid, $12,200 in this case, that becomes our cost of goods purchased. So if we started the year with $36,000, we purchased goods worth $320, that means we had cost of goods available for sale of $356,000. We go out on December 31st and do a physical count. Lo and behold, we have $40,000 worth of goods on hand. That means we must have sold the rest, or $316,000. So continuing on with this PW audio sock stereo, if we're doing a sock stereo records, sock stereo is using a periodic system, and when it receives the good, it debits purchases and credits accounts payable. If it pays for a freight of $150, it debits freight in and credits cash for $150. If it returns $300 of the goods because they were defective, it debits accounts payable $300 to reduce that account payable, and credits purchase returns and allowances for $300. Finally, if it takes advantage of that 2% discount, you'll recall that was $70. Makes this entry: debit accounts payable to eliminate the accounts payable, credit purchase discounts for $70, and credit cash for $34.30. PW Auto, on the other hand, records the sale of $3,800 as follows: debit accounts receivable, credit sales. And since it's now using a periodic system, it doesn't make any entry to its inventory account. Record the return goods received from Sock Stereo. They record the $300 sales return as follows: debit sales returns and allowance, credit accounts receivable $300. To reflect a 2% discount, debit cash $34.30, debit sales discount, credit accounts receivable. So here's a comparison of the entries on Sock Stereo books, comparing perpetual to a periodic inventory system. So that on the May 4th, perpetual inventory system debits merchandise inventory. In fact, everything in that column there impacts merchandise inventory, because we're keeping track of it on an ongoing basis. Where in the right-hand column, the periodic inventory system, we never do anything to merchandise inventory account. We have these other accounts, purchases, freight in, and so on, that we use. We only use merchandise inventory account at the end of the year when we go out and take a physical count and adjust it to that amount. This is the companion entries that you make on PW Auto Supply books. worksheet for end of year worksheet. You notice here that we have sales returns, allowances, sales discount, cost of goods sold. Those are all income statement items, so they get carried over to the income statement. Notice that they normally have debit balances, and that they do here. Merchandise inventory, of course, has a debit balance. Adjusting entry A here is for going out and taking the inventory and correcting for the difference. So that's end of Unit 5. Study the chapter, read carefully. Keep in mind the difference between periodic and perpetual. Don't be afraid to take some good notes and have them available for when you take the test. See ya.